So the big question here, Morgan asks in the Facebook group, what are ballpark premium figures for TPD, total and permanent disability, life, and or trauma cover? What's the ballpark? How do we get people to know?
Yeah, it's a bit difficult to answer, but I've got a quote up for myself. So just to give some rough numbers, but the reason why it's difficult is it's based on everyone's occupation, whether you're a male or female, whether you're a smoker or non-smoker, health history, family health history. So there's a lot of things that factor into the cost of cover.
Age,
yeah, how old you are. So I didn't want to give an answer with
and level of cover. How much cover do you want?
Exactly.
So there's like 6 things off the top of the bat.
Yeah, exactly. And so you and me, we may be similar age, we may have similar types of occupations, but it depends on our duties of work. So it's a little bit difficult to answer. Without giving a complete non-answer, I've just done a quote for myself. So if I'm to get life insurance at $1 million, disability insurance at $1 million, and trauma at $150,000, and income protection as well. So I've added that onto the cover, assuming I'm earning $150,000 as well, which would be nice. But so for myself, a rough quote is this total level of cover for myself, and other things to note. I'm a white collar worker, I'm a non-smoker, and I'm, next birthday I'm going to be 39. So for me, the cost of cover from super is $1,730 per year, and the cost of cover out of my bank account is $30 per month. So one thing to note, just in terms of what's structured in and outside of super, we can touch on that in a bit of detail. But overall, the annualised premiums, if you add both of those up together, it's just under $2,400 for the year, not $24,000, $2,400.
I shook.
Yeah.
So for most people, it's actually affordable if you step back and go, okay, what's the net tax cost? Because a lot of that cover in the super fund, you'll get a 15% tax rebate in the super fund.
Yeah.
Any income protection out of superannuation, probably between 90 and 100% will be tax deductible.
Yeah, exactly.
Warren actually asked, what's an appropriate amount of cover per 10K of income? That's not a question you can actually answer, is it?
Again, so the 4 different types of cover. So income protection is fairly easy. So we like to cover 70% of your income with income protection.
And is that the maximum that you can get?
Exactly, because that's the maximum you can get when it comes to income protection. But in terms of the level of cover, the things that we look at depends on your level of debt. So if someone's earning $150,000 and got no household debt, maybe they don't need as much cover for the others amount. So income has a big determining factor on the level of cover that's needed. But yeah, it's not like a X times income is what's needed generally.
And maybe Warren was kind of talking about, because when he said what's an appropriate amount of cover per 10K of income, remember there's that old thing where people go, well, if you earn $100,000 a year, you want 10 times your income for cover, which is $1 million. I think you can actually be a bit more nuanced with that.
Yeah, exactly. And that's similar to the way we think about it. We don't just go X times income, which is, again, depends on 2 households may have $1.5 million worth of debt, another household, no level of debt. The level of life and disability needs is completely different.
Or I might have, I need, quote unquote, 10 times 10, so I need the $1 million of death cover, but I might have $500,000 in my super account, which we could net off that as a need. And I think it's important that we look at the need and work backwards for everyone individually, as opposed to saying blanket, get 10 or 20 times your income, whatever that is.
Yeah, exactly.
The next question is from Padmaker. What are life and income protections, or why are life and income protections so high in Australia, specifically over time, and are they still worth it? We have are they your notes?
Yeah, that's my notes.
Phil's making notes under the questions. So
I'm doing my homework.
That's right. I was about to read your notes as... Anyway, proceed.
So the first thing to know is we have very generous types of policies in Australia. So like things like income protection that can pay out on mental health conditions is very unique in Australia. So that's the first thing to note. Our policies are very, very generous. In a lot of other countries, they have very basic levels of cover where you've got to be really significantly disabled before you can make a claim, or if it is, it's just a life insurance policy. Things like trauma insurance and income protection are very generous in terms of their policy definitions. So there's that, but we do a little bit of work comparing overseas policies, and the premiums in Australia are relatively affordable compared to some other countries. And some of the reasons for that is we've got compulsory insurance within superannuation. So all super funds have to consider the insurance needs of their members, which means there's big group policies, which does mean there's a lot of insurance policies across Australia. So that does bring down the cost when you've got a big group. So there are things like that where it does actually make the policies in Australia relatively affordable.
Yeah. And I think the question, and are they still worth it? Well, I think if you've got an income, you need to protect it. Now, if you don't need to protect it, does that mean you don't need it? But it can get nuanced. Like if you lived in an area and your home insurance was $17,000 a year, that's a tough pill to swallow, and you're probably going to take a bit of a risk there, or maybe insure half the value or do something. And we just need to, kind of like Warren's question and even Morgan's question, let's look at the need, look at the exact numbers, get a price, then let's have a discussion.
Yeah, exactly.
Rather than, I don't want to do it because it's, no, let's look at the need, get a price, then have a discussion, and then we can tweak.
Yeah, the beautiful thing about insurance is it's not a matter of just keep it as is or just cancel it all. We can dial it back. So we can always say keep everything as is, dial it back halfway or a third of what it used to be, or cancel the whole thing. So that is a great thing about insurance policies. It's not all or nothing.
Well, our episode today is brought to you by Sphere Home Loans, because your sponsorship, Phil, gets read out in the middle of the episodes.
Yeah.
So we won't mention our top of the show sponsorship partner in this episode, Sphere Home Loans. But who are you and what are we doing here today?
Hey there, I'm Phil Thompson. I'm the CEO at Skye Wealth, and you're listening to Money, Money, Money podcast.
You're listening to Money, 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 or as the regulars like to call us, M3. Everything discussed on the podcast is general advice only, which I'm licensed to give, and details can be found in the show notes. My name's Glen James, former financial advisor, now podcaster. I host this show and a show called Retire Right. I've also got a book called The Quick Start Guide to Investing, which you can check out wherever good books are sold, or there's a link in the show notes. Otherwise, thanks so much for listening today. Now on with the show. In finishing this little section about the cost and the value of insurance, Adam says, I want to unpack this.
This is spicy. I like it, Adam.
Isn't life insurance basically a scam if you're under 40? Look, I want to interpret that. I think he basically may be saying, a lot of people would automatically get life insurance when they're young in their super. That's a scam because you don't need it. So I think maybe Adam, politely, maybe you're out of touch and don't understand, or I don't know why. What's with this 40-year-old?
Yeah, I think.
Why is it so? Why is his age so much 40? And if you're under 40 and you've got insurance, scam. Over 40, you've got insurance, good, not scam.
Yeah, so there's a few things here. So number one, if it was a scam, insurance companies would be wildly profitable because they would just be making so much money because they're not paying out. So there's that, which isn't the case in Australia. Insurance companies are making a 6% profit margin in the last quarter. I had a look at that this morning because that's kind of what I do. I geek out over insurance stats. Number two, there is a little bit of fun fact here, the government actually make it harder for super funds to set up policies for anyone under 25. So Adam's kind of, in the camp of what the, previous governments have done, where they've made it harder to get policies up until when you're 25. Now, I personally don't love that policy from the government because there are people who pass away younger. Like I've helped clients claim on life insurance under 40 years old. So it's a scam if you don't claim. Every insurance policy is a scam if you don't claim. But I've helped people and I've had friends claiming on life insurance policies under age 40. So I know for their family, it wasn't a scam.
Ask them if it was a scam.
Yeah, they paid much less in premiums than they ever got. But going back to that quote before, the life insurance portion on this fictional quote was $330 per year for $1 million of cover. So I could never save up enough money for my family to get $1 million.
And I think without wheeling Adam in for him to unwrap this more, life insurance is the broad category of the 4 types of personal insurance: life, total and permanent disability, trauma or critical illness insurance, and income protection. Maybe, I don't know if he's talking about the scam as if it costs heaps if you're under 40 and it's not priced that way from an actuarial point of view, or that blanket, if you're young, quote unquote, you don't need it, therefore scam. We don't know. But we just always got to go back to whether we're talking about life insurance, car insurance, house insurance, whatever that is, we identify if there is an insurable need present, number one. And if you are 29 and you've got 2 kids and a mortgage, I think having life insurance for the parents, that's not scam territory for me.
That's a necessity. Like,
Yes.
when you first have your first kid, you're thinking more about your future, more about, how do I protect these little babies that, we brought into the world. And so, we'd love to have a conversation with Adam.
Yeah.
And
in
each
fact,
to
we've got
their
him right
own.
now. He's coming in. Yeah.
I mean, and each to their own. At the end of
Yeah.
the day, we all pay for insurance premiums that we hope we never need to claim on.
And some people are just anti-insurance, and that's fine. Like, I know friends of mine who drove around for years without with the compulsory third-party insurance, but not third-party damage. And I'm like, for $300, $400 a year, I'm doing third-party, even if I'm anti-insurance. So you can be anti-insurance. That's fine. Just don't bitch and moan if you have a claimable event and you don't have any money to replace that need. Caitlin, all right, you might nerd out a little bit here because you can maybe talk to us about the philosophy at Skye. Caitlin said, run me through stepped versus level premiums again.
All right. Well,
Strap in, kids.
Yeah, strap in, because what's even better is the regulator made changes to those terms. So now they're actually called variable age stepped, which is the old stepped.
Good.
And now the new level term is variable to age 65. If I gave you those two terms, would you have a clue what they are?
No, that's ridiculous.
I literally have to work it out every time. I look at
variable
a quote.
to age 65
is
because
level.
At age 65, the quote-unquote level would stop and it reverts to every year.
Yes. And they use the word variable now because the regulator didn't love the fact that level premiums could move based on discretionary pricing. So, that's...
But the premium it would just mean that the premium wouldn't go up year on year because of age.
Correct. So stepped premiums and level premiums, we still use it internally at Skye because, as I said, we don't really understand the new terms either. But so step premiums means that your premiums will go up every single year. You're getting older. You're more likely to claim on those policies. So those quotes earlier that I mentioned were stepped, were the cheapest today. Now, premiums can go up for two other reasons. Now, if your level of cover goes up, so $1 million today, next year it's $1,030,000, then your premiums will go up accordingly based on your level of cover going up. Now, that's called indexation. And then the third reason your premiums can go up is a discretionary pricing from the insurance companies. So at the end of the day, the insurance companies, they price their own products. They try and make it accurate today. But in the future, if they become unprofitable, they can say to the collective group, we need to increase everyone's premiums. And that's what's been happening. There's been a lot more discretionary pricing over the last 10 years than had been prior to that. And so that's why the regulator came in and said, we've got to change this term level because it's not actually level. So
CommInsure used to have one 1 million years ago that was a true level, but also they increased eventually.
Well, yeah, true level means that the indexation
is based on the application age.
Original, the original age. So level premiums can go up for two reasons and two reasons only. So it can go up for discretionary pricing and it can go up because the level of cover goes up. But it can't go up because you're getting older, just because you're getting older. So historically we liked, my policies are on level.
Yeah, mine are
Your
all on
policies
level.
on level. Historically we did like level premiums. But there is a question about pricing that we may get into a bit more deeper into this. But at Skye, we now look at a lot of the stepped pricing because the differential between level and stepped is becoming really difficult for a whole bunch of reasons because of the discretionary pricing, and insurance companies are doing kind of initial selection discounts as well. So it does make it very difficult.
And this is the problem, like the insurance industry at the moment in Australia, it's so bad. Most companies have a new business discount. So, we'll give you a 20% discount for the first year or 3 years or whatever they choose, 5 years. Then overnight, your premium will just jack up. It's just so outrageous. It's so bad. And they're all doing it.
Yeah. 100%.
Are there any that aren't doing it?
There was one that wasn't doing it, and they, for 5 years, were screaming, kicking and yelling, saying everyone else is doing it, but we're the only ones who weren't. And then just end of last year, they brought out their initial selection discount.
Yeah.
So they jumped on board because, they had to. At the end of the day, if everyone else is pricing a product in a certain way, you just
the market
can't.
Will follow.
Yeah, you've got to follow as an insurer. So it is a difficult situation.
So speak with your advisor. You might go to an advisor to get insurance that isn't through Skye Wealth. Ask them to explain why they've selected why they have. And I think historically, advisors have just done a really bad job of explaining level because people were getting shocked. Oh, you said this wouldn't go up each year. And then, 3 years of consecutive increases. I always used to sell it as this premium will never increase because of your age. Simple as that.
Yeah, I think advisors in the last 5 years have not sold it that way because we've all seen it move. But historically, those prices weren't moving. When you were giving advice, the prices weren't moving. So why would you communicate it any different?
No, but it would increase each year because of the CPI index.
Correct.
And the new added bit of CPI was based at your age today, not at the start date of the policy, which is level. So...
But even that CPI increase, that is the pricing that is, the policyholder can turn off that CPI increase. So you can always have some level of flexibility with level where your premiums theoretically could never increase if your level of cover didn't go up.
100%.
Until these discretionary pricing came
We used to actually have fixed term level where you could say, I want a 5-year or 10-year. And that was the old school term life because of the term of the policy. Health conditions. Belinda said, would love to know how on earth you get decent cover after health dramas. Josh also said, how do individual factors like high BMI affect an application and premium? So talk to us about those two questions there.
Yeah, so I'll just go to first Josh's question about high BMI. So there is a loading that the insurance companies place. So they just charge a higher premium based on a high BMI. So different insurers have a range of what they call healthy BMI, and then they have an upper limit where they won't load it, and then over that limit, they'll start loading, so a 50% premium increase. So that's normally how they manage that BMI rating. When it comes to, how do you get good cover, after health dramas, I mean, it really depends on what health dramas. Some are more significant from an insurance point of view than others. So, things like if you've had cancer, then it's going to be very difficult for an insurer to cover you within a certain number of years. But if there are some things like, breaking an ankle, then, maybe you'll get an exclusion within the first 12 months, but symptom treatment free, the insurance company won't negatively impact.
Or even if you had a high BMI, because statistically the data says high BMI, there is a higher chance of a medical event.
Yes.
Statistically.
Yeah.
And sure, BMI might not be the best measure of whatever, but here we are. We see it sometimes. We had someone the other day reach out to me after they had seen your business, and I had seen these words in the Facebook group and other, I would say, issues or complaints where people have been declined cover based on health. They start talking about human rights. Now, when it comes to insurance companies, human rights is cute, but if you have high blood pressure, the data says you've got a higher chance of needing to claim, therefore we have to charge you more.
Yeah. Yeah. I mean,
so how do we dance around this? You are declining me cover. That's a violation of my human rights, as opposed to, well, the data says this.
Yeah, the human right is about discrimination. You can't discriminate against someone really willy-nilly. Now, insurers have an exemption when it comes to discrimination. They can discriminate against anyone as long as they've got scientific evidence to discriminate against them.
Based on the actuarial stuff.
Yeah, based on their numbers. And insurance companies, they're not just like cowboys out on their own making these things up. They get reinsured. So global insurance companies will cover a lot of their cost when it comes to claims. And that's where they get a lot of the data from. So they have an ability to discriminate, which is exactly why males and females have different premium structures, because that's a level of discrimination. Occupations, being white collar versus a builder, that is discrimination.
Why do I have to pay more because I'm a bricklayer as opposed to an office worker? You're discriminating against me.
And 100% it is, but the insurers have the ability to discriminate and price discriminate because of that data that they says that if you're a bricklayer, you're more likely to claim on these covers and therefore we'll charge you accordingly.
And it's very similar because I still do to this day explain it to people. It's like, just step back, house caught on fire. If you called the insurance company and you said, yeah, the house is currently on fire, can I insure it? What are they going to say?
Yeah, no, thank you, but no thank you.
No, thank you. Yeah. Because that means there would be a 100% chance of that insurance company paying out more than the $1,000 they would have received for that policy.
Yeah.
So it's an insurance pool that needs to be protected as much as possible.
That's right.
For the greater good of the pool, right?
Yeah, and a big one these days is mental health. Right. This is a really big issue that all insurance companies are dealing with and managing their cost of mental health claims, because those costs are skyrocketing. And so when clients get, we even had new team members coming in, new young team members learning about insurance, and they're like, oh, how do we advocate for mental health? And so, I took their questions to the head of underwriting with a major insurer in Australia and say, hey, here are some questions that we're getting internally. How do we discuss this in mental health and what are the claims experiences with other countries? Because they're a part of a global insurance company. And at the end of the day, the insurers can lean back on their claims statistics and says, we're paying out, I think, over the last 10 years, mental health claims for disability has increased 730% for 30 to 40-year-olds. And so that's data that they can lean on to say, hey, we need to be much more cautious to protect our pool of policyholders. Therefore, we're going to be quite strict on mental health treatment or symptom in the past, because we've got to protect that pool of insurance in the future. So, and it's all related, and that's discrimination.
Yeah.
And it's all related on to their claims data that they're seeing.
I had a phone call on Friday, and I actually haven't told you this. I was going to tell you in our on Facebook chat, and I'll tell you because it's just it's like a half industry story that talk to Phil about and a half lesson about underwriting. So I rarely answer my phone with numbers that aren't in there, right? Because I just get ambushed, like this phone call. Pick up the phone. Hey, Glen here. Oh, hey, Glen, it's X. I'm like, oh, hey, mate, how are you? Used to be a client of mine.
Mm-hmm.
And, a bit of a chat. Yeah, what are you up to? And it was a friend of my sister's, and all that. So I didn't mind just catching up. And he said, oh, hey, you set all those policies up for us, 10 years ago. We actually purchased a property in a self-managed super fund, and we just cancelled all the policies that you set up for us. And my instant reaction was, they were level premium, back in the good old days. Anyway, we're here now.
Yeah.
Never cancel your policies that are level premium.
Unless you talk to an advisor.
No, unless you're talking to an advisor and unless there's a bloody good reason. But I know the ones that I would have set up.
No,
you don't touch them.
Yeah, not the old ones. Yeah.
No, not those ones. Anyway, so I said, yeah, that's all good. They said, oh, and I just wanted to ask you, we're going through this advisor at the moment, and they're asking all these bloody questions and all this. And have you got a recommendation for another person to go through? And I instantly thought, well, it's not the advisor issue. It's the underwriting process. And I said, oh, look, just who's the insurance company? Because he said the advisor in North Sydney or something like that. And I said, look, just forget it all and go to Skye Wealth. No, I didn't say that.
Yeah, I was going to say, they're already through the process. Go.
And she's in the background. I won't say their names. She's like, oh, Clearview. I'm like, Clearview. I say, awesome. So the advisor has recommended Clearview as the insurance company. What you're going through now is normal underwriting. And he goes, yeah, they just want to know all these questions. And I said, a couple of things. As we get older, we have more complex health things. And I said, I'm not introducing you to another advisor because it's not an advisor problem. This is a medical underwriting thing that you're going through. So I said, what you need to realize is, because then he goes, oh, my staff, we use the CBUS super for group, for the employer super. Should I just go through CBUS? I was like, no, continue the process if it takes a little bit of time, because if either of you died prematurely or whatever, we don't want to do all this process at the time of claim. We want to make sure that they've got as much information as possible. They can issue the policy, and then at claim time, we don't have to do all this digging.
And if you got real levels of cover within CBUS, you'd be doing all the same thing anyway. So
yeah, long story short, he basically is like, all right, I'll just keep on keeping on. But I said to him, because I couldn't help myself, I'm like, who's the frigging person that set up the super fund for you? You could have transferred the policies that I set up to be paid from the self-managed super fund, not just cancel anyway. But all that to say, with the mental health thing, I had a claim, an ex-client of mine, because, I had a good relationship with a lot of my clients. They called me the other day, full TPD claim of the policy that I set up for them for mental health, PTSD. And they had the certainty at claim time. Met the definition, no pre-existing illness on mental health.
Yeah.
Claim paid.
Yeah.
So it sucks. I personally have a mental health exclusion on half of my cover. The first half was before I knew that I had depression, anxiety and all that. So any cover after I knew about it had an exclusion on there. So to Belinda's question, would love to know how you get decent cover after health dramas. You take what you can get with an exclusion.
Yeah, and work with an advisor who's going to ask all the questions up front, because the difference between the insurers is pretty vast. And so, yeah, it's super important that working with an advisor. Simone actually asked the question, why can't insurance inside super be transferred like super itself without new medicals?
Well, it can if you set up a policy through an advisor that's outside that super fund, but I'll go to you for the professional answer.
So if you've got an Australian Super account and you've got a policy through Australian Super, it's not Australian Super that owns the policy. They're not the insurer. It's actually TAL, who's a major insurer or the biggest insurer in Australia. So you can't transfer that Tower policy into a Host Plus super because their insurer is MetLife. So it's a very different insurance company. So they want to understand the risk. Even if you went from Australian Super to another super fund that both had Tower, there's still different pools of insurance, still different groups policies. So that's why you can't transfer if you're moving, if you have the policy through the super. Now, if you go through an advisor, we can set up policies, as you said earlier, Glenn, where we can own it through the super fund. So Australian Super can kind of pay for the premiums, but it can be moved across. So if I go from Australian Super to Host Plus or any super fund, then we just sign one form to say, hey, now pay the premiums from this
I always think
fund.
what's a really easy way to explain it to people so they totally get it, and I still struggle with this, it's almost like the advisor the insurance company provides a superannuation product or a superannuation fund, but there is no investment component at all. The only thing in that fund is an insurance policy. So each year, like you can roll your super over, you can roll a portion of your super over to the super fund that the insurance company set up, which just has insurance in it.
Yeah, exactly. So,
and if you log into your ATO, you will see your Australian Super or whatever there, and that's the balance. And you'll see another policy, Tau Super, Clearview Super. Yeah. So that's exactly what it is.
And it's the best way, especially for young people who may want to move their super around, because at the end of the day, super is an investment vehicle. If I really like Australian Super and the way they invest my money, great, I want to go there. If I want to set up a self-managed super fund like your friend did and go and buy investment properties or whatever they want to do, having your insurance not linked to that account but still being paid by that account is incredibly important.
I still do a yearly partial rollover from my super fund to my super trustee policy. It was easier than cancelling and reissuing the policy owned by the super fund.
Oh, because you got a self-managed super fund.
Yeah, that's right. Yeah. So.
Yeah, you can do both. When you got a self-managed super fund, you can manually make that payment, or you can just own it through that super fund.
Yeah, and then the money will get debited from the super fund bank account. Yeah. But it was just 6 one, half a dozen the other.
Yeah, exactly.
Let's take a break and we'll be back right after this.
If you're after personal financial advice, don't get it from a podcast. But if you want guidance tailored to your situation, head to moneypodcast.com.au and click Get Help. We'll connect you with one of our trusted professionals, financial advisors and mortgage brokers, who work with people right across Australia. No matter where you are, they can help. Now, before we get back to the show, a quick reminder to protect your financial life. That means having income protection sorted. It means having death cover if there's any debt or dependents relying on you. It means getting your personal insurance in order. Most people insure their car, they insure their house, but what about themselves? Skye Wealth, who support this podcast, are specialist financial advisors who can help you get the right cover in place. Their advice is often more comprehensive and better value than going direct through your super. Book a complimentary 15-minute chat at skye.com.au. That's skye.com.au, and they'll point you in the right direction.
Okay, following on from the super discussion, before we get to that, Phil, do you want to just have a read of Kate, Thomas and Nat's question? See if we need to cover those. Just a reminder, if you do want to join our Facebook group, you can do so, Money Facebook group. Make sure you put in the Facebook group, where did you hear about it? Episode 825 or whatever the episode number is, because we'll categorically know that, a spam account. Phil, there's probably, I let yesterday 40 requests to join our group yesterday. I think 4 of them
were real people.
Real people. Oh. So you see all these big groups with like 300,000 people in them. Trust me, it's not real.
Yeah. What a pain in the neck for you, for administratively.
Yeah, it's, what do you do?
But so, it also makes the community.
Yeah, so we don't add anyone from overseas unless they say specifically, I listened to the podcast or this episode number, because I want it to be very pure for podcast listeners. So yeah, if you're joining the Facebook group, put the episode number in the title. All right. What do we got?
Let's go. All right. Kate is asking the question, is it worth leaving default super insurance with no exclusions for a better quality policy outside of super if pre-existing conditions now apply? It's a great question. So a lot of what we like to do is keep that default cover where it is because, as you said, Kate, it doesn't have exclusions on it. But the policies themselves, may not be great quality. But if you're going to get a mental health exclusion somewhere else, then you may as well keep that, even if there are some downsides to that policy. But what you can do is you can actually hold both. You can hold it outside of super and hold that cover. So historically, what we try to do is we try to mix and match the covers together. Now, these days at Skye, what we like to do is take out full retail cover externally, unless there's a lot of cover within the default, and just keep those lower levels of cover.
Okay, so question on that. If you did a risk needs analysis and, for example, this person needs $1.5 million of money should they die. So the need is $1.5 million, less $400,000 in their super, which they've actually got, $400K, because we don't need to insure that, which means maybe we need $1.1 million of death cover. If they had a default $100,000 of death cover, for the sake of the needs analysis, would you just ignore that and still recommend $1.1 million?
Yeah. These days we do. And the reason we do that is because we've seen over time a lot of our clients will move super funds.
Right.
And so if we're building...
Is that more of a business risk liability thing or a bit of both or just...
Well, no, because, our clients are moving super funds. They want the ability and flexibility to move super funds. And so what we've done is we've said that $1 million within the default cover is going to reduce as well over time. And we can touch on those taper downs. But, we don't believe, most default super covers, they will come down really quickly. So and today maybe $100,000, but literally you're 2 years older and it can come down to $70,000.
Yeah.
And so that's something that we know with a new policy we can't match that decrease as easily with an increase.
But I mean, there's probably just for the client of you, aka listeners out there, you want certainty with stuff like this.
Correct.
You're not going to get certainty from unitized cover within a super fund. And maybe just jump in, how does that work and decrease when it's a unitized cover?
Yeah, so unitized cover means that you have a certain amount of units.
So you might have 6 units or 5 units and each unit is $20,000.
Yeah,
so
exactly.
$100,000.
$100,000 today. Now, those units within the insurance PDSs, within the super funds, which, I looked at the top 4 super funds in Australia and it took me 45 minutes to work out these tables. So it's not that easy to find these numbers, but you can look at the PDS and it says, if I'm 39, you will get, 5 units of $20,000 each. But once you're 40, each of those units will become $15,000. Okay, so now I've automatically gotten $75,000 worth of cover and I've just had my birthday. So, I'm just a little bit older.
So you kind of look at it a couple of ways. The trustee, aka the super fund, has a responsibility to provide some cover for their members. Yep, awesome. The group cover, yes, awesome. In theory, as we get older, our assets should be growing, which should in theory mean we need less death or TBD cover. But the problem is you want to have that control of when to drop your cover.
Exactly. The other reason is the trustees have the discretion to change these policies over time. So, historically, Australian Super, their disability benefit was not too bad, but now they've just weakened their disability benefits, which, historically, if we relied on that cover, even if it was $160,000 worth of cover, we're still relying on it at the time of claim. Now, as an advisor, I don't know what that term is going to be at claim time. So I don't know if we're going to claim in 5 years or 10 years' time. And the trustee may say, actually, you know what, those units, we're actually going to dial them even further back because that's a discretion trustees have for their members. They're insuring millions of members.
I remember at the time MTAA Super used to be for the motor industry, which I think they're now Care Super because they've all merged and whatnot. Overnight, a client sent me a letter, their default cover of, $400,000 of TBD cover. It said from 1 July this year, your definition of TBD is changing. So it was an any occupation definition. The old definition was you are unlikely to work in any job or occupation that you're reasonably suited or trained for. We are changing it to you are unable. So same definition, one word change overnight, which you have no control. And it's probably more because that, I think you touched on before with TAL, the super fund every 3 years, they may have retendered the insurance and the new group super said, yeah, we can do this, it's cheaper. But the TPD definition is harder to beat. That's why it's a bit cheaper.
And that's it. And people may have missed that. You know, the difference between unlikely to go back to work and unable.
Yeah, hey, doctor, do you reckon I'm unlikely to ever work again? Oh, yeah, probably. Oh, doctor, am I unable to ever work again? Oh, I'm not going out on that limb.
Maybe in 5 years or 10 years' time, we'll be able to make that assessment and sign off on it. So that's the reason we've made a decision we don't disregard the default cover. It is really important, and we think it's important for people to understand and know that they've got. But the issue being that the trustees can make changes, when they need to, at the benefit of their millions of members, is really important. Another example is this consolidation of super funds. So I'm sure a lot of listeners will be with a super fund that they may not have signed up with because there's a lot of consolidation. Another example is Sun Super and ART. ART merged with Sun Super. Q Super merged with Sun Super
and
became ART. That's right. And so those two different super funds had different insurance policies and they had to pick one. And so they picked, the old Sun Super one, and the TPD is based on what's called TPD Assist. So they won't pay you a lump sum payment. They'll pay you over 6 years. They'll pay you, which may not suit certain members. You may be planning a lump sum payment. So that's why, at Skye, what we've done is, yes, we think it's super important to keep, but we actually want to double up to create the certainty that you will have, what you need to at claim time.
Is it still true that any retail policy an advisor sets up for a client, the contract basically says that the insurance company can't make it worse off than what it is, like that guaranteed renewable?
Yeah, exactly.
Is that the term?
Yeah, guaranteed renewable. So it means that the contract you sign up for, on the terms and conditions you sign up for, as long as you keep paying your premiums, it'll never change on you.
Yeah, and they'll never cancel it if you keep paying your premiums unless they pay a claim or they find out there's some fraud, basically.
Exactly, yeah. So it means that you've just got more certainty at claim time, which is super important.
Yeah, because you're buying the chance of a claim with any insurance policy.
Yeah, exactly.
Gosh, Thomas, what's the pros and cons of having income protection inside super? You got 30 seconds to answer this one, Phil.
Yeah, so cons is you've got to be gainfully employed at the time of claim.
So maternity leave, long service
all
leave.
Of those issues you may not have.
Even with a policy an advisor sets up that has do they still do the super split policies with 80% out? But the outside split would catch that?
Correct.
Okay, cool.
Yeah. So there are some, if you set up a policy with an advisor, actually these days all your income protection policy can be paid through super, and they give you this free benefit outside of super, which don't understand how they do it, but they've passed it by their legal
ATO
team.
ruling, CIS Act ruling, ATO ruling.
They've ran it by their lawyers.
We'll take it.
So that's some of the downsides. Again, if you have it through the group provider, what we were talking about before with the TPD definitions, they can do the same thing with income protection.
But from what at the end of the day, retail cover set up by an advisor, even though it's paid from your super fund, is still better than the default group cover.
Yeah, correct. Yeah. So it's not necessarily super or non-super. It can be super with an advisor.
Could be a retail super policy as opposed to a group super policy.
Yeah, exactly.
Nat, what's the difference in claims process or assessment between default cover and voluntary cover?
Yeah, so claims process across all insurers are signed up to a code of practice. So
they're getting spanked for it lately.
Yeah, so they have to get back to claimants within a reasonable time frame. So generally speaking, the claims process should be somewhat similar across both super and default cover. Sometimes, to be honest, default cover is easier to claim on. Their average claim size is $165,000. So as an insurer, you kind of make a business decision and say, do we fight and spend $50,000 worth of, staffing to try and, wiggle out of this, or do we just pay the claim? So that's why sometimes you will see a higher claims acceptance rate for default cover.
Well as if it's a default cover, the member's been in the fund for over 5 years, there's such a minute chance of fraud or medical stuff because they're...
That's right. And there's no health disclosures that they need to worry about. Was there a non-disclosure or not?
So the only thing with some default cover, and you can correct me if I'm wrong, I'm here just learning myself, is it true that some default covers now will still have in the fine print, here's welcome to Super Fund A, here's your default group cover provided by MetLife, TAL or whoever, 200 grand of default death cover. If you died the week after from cancer, they're not going to pay because in the fine print there is like a 3 to 5 year term that we don't cover pre-existing.
Yeah, it depends on the insurer. They're more outdated than, so they're not that common anymore to have those type of things because they just give it to you as a default. Now,
So what you're saying now is the default is an automatic acceptance.
So it is automatic acceptance.
So if I've got cancer, go and open.
No.
Okay.
So yeah, that's a great question. I don't believe if you have a known diagnosis.
Right.
But
it goes back to if your house is on fire, don't try and call the insurance company.
Yeah.
Sure, you might get it paid and be fraudulent, but don't expect when the house is burning to call the insurance company and go, yeah, we'll issue the cover. And then when you go to claim 3 weeks later, they decline it.
Yes, exactly.
Yeah, okay. I think I read Nat's question as the difference in default and voluntary cover. The way I see it is like, well, I've got default cover of 300 grand and I call the same super fund in the group policy and add in a 500 grand group cover. It would be the same because it's the same insurer, right?
Well,
or are you saying they might carve off the default?
Yeah, so if you go and increase cover within the super fund, sometimes depends on the policy at the time you set it up, but there may be exclusions on that additional amount.
Yep.
Versus, the default cover is like $150,000. It's so minor.
Yeah.
I think the biggest out of the top four.
But I mean, the claims process would be pretty similar.
It will be similar, but they will want to know if there's any non-disclosure issues,
Right.
or they will go through that, disclosure at the time of application. Yeah. Was that true? Was that correct?
So there could be a case potentially where, it's a TBD claim. I had 200 grand of default cover. I increased it to 500, 300. There could be a case where I make a mental health claim and say, hey, we'll pay the default cover, but we're not paying the increase.
Yeah, that's right, because it was a non-disclosure. Because you filled out that questionnaire on the couch at home, and you just accidentally ticked no.
Yeah. Okay. Okay. 2 quickies, as they say in the business. Daniel, how does your spouse claim in the event of something happening to you? Okay. I drop dead, and my wife, who am I married to? Taylor Swift. Tay-Tay is like...
Tay. She gives me a call.
Tay-Tay is like, oh, crap, Glen has died. What do I do?
Yeah. So, again, depends on if you're through the super fund or if you're working with an advisor, but give a call to the super fund, and therefore the insurance company will get involved and make a claim. But essentially, when someone passes away, you get a death certificate, and the insurance company will work with the spouse. There will be some proof of who you are and your relationship and marriage certificate and things like that.
It's going to be hard because when Tay calls like MLC, my insurance provider, they're going to be like, yeah, right, this is Taylor Swift, please.
Exactly. And so there needs to be some proof of, that Taylor is somehow
who she
involved.
Says she is.
More who you say she is to you.
But look, it's a pretty simple process, Daniel. Like, I think the key here is tell significant people in your life, like my family know, here are the details, it's in this filing cabinet or whatever, it's in this folder. Call Phil if I die. And it's actually
I literally wrote an email to my dad, my sister, and my wife saying what to do when I die.
Yeah. I didn't get that email. Pop the champagne. Woo! Okay, we'll finish. There's another one from Nat. don't know if it's the same Nat. We only use first names here. If you're seeing a financial advisor who includes insurance, is it necessarily to pay for both services, advisor/broker? Do I understand this?
I guess maybe, if an advisor's getting paid a commission and charging me a fee to do superannuation or whatever.
Right.
I guess so. Or at Skye Wealth, we charge a fee as well as get paid a commission.
Yeah. And the reason why is because the commission rates just have been reduced so much as well.
Yeah, there's a few reasons we do it at Skye.
You've got to be a profitable business.
Yeah. There's the other reason is we just want to make sure people feel comfortable going ahead and there is no kind of awkward obligation. At the end of the day, you paid for a service for us to do a lot of research up front. So coming back to those health questions, I think was from Belinda, we do a lot of research on everyone's individual health history and then make a recommendation based on someone's individual health history. Now that work is significant amount of work, and so we charge for that. And whether a client decides to go ahead and take out the insurance or not is irrespective of our advice that we charge for. Now we try and keep those costs low because it does the commission. We do get paid a commission from the insurance company, and it does fund a lot of that initial cost. But we don't want our clients to either feel obliged to go ahead, or we don't want to feel like we need to pressure people to go ahead.
Mm-hmm. Yeah. So there you have it. Stephanie says, the importance of asking for projected step premiums over 10 years, mine jumped from 8K to 20K in 3 years. Okay.
Yeah.
I'll buy it.
Yeah, I've bitten. So it's obviously hard to tell without seeing the premium projections or Stephanie's cover and the age of Stephanie. If you're setting up policies maybe in your late 50s, that may be a jump that's happening. But we did talk about earlier, there's kind of three reasons I can see this cover going up. So number one, the projections that were originally provided may not reflect these numbers because the insurance company can do what's called number one, a discretionary pricing. So they can say, hey, we're re-rating the whole business to increase by X percent. So even though you signed up, Stephanie, at $8,000, there may be a re-rate in there. And the other thing is there may be an inbuilt initial selection discount. So
which we talked about.
Yeah, we touched on insurance companies are discounting in either year one and discounting over the first 4 years or even over the first 10 years. So they could have dropped off of 30% over 5 years.
I think I read this incorrectly. I read it as within her projections, the projections jumped from 8 to 20, but I think Stephanie's saying check the projections because I've had this increase, but she's just been caught like many people with the doubling of some TBD and income protection policies in recent years.
Yeah.
Which also speaks to projections being squat, to be honest.
Yeah. The premium projections in recent times it's important to know what is that default cost increase going to be because there are initial selection discounts, and that's something that at Skye we're doing a huge body of work to try and make sure we understand it because I'm looking at two of these quotes that I prepared for, and one of them doesn't even talk about their initial selection discount, but we've done a body of research working out what that is, and that's 30%.
Do you provide the projections to clients?
Sometimes we do. I mean, if clients ever want it, I don't think we do by default.
I think people need to know if you are getting projections from the policies from the insurance company's quote software through the advisor, you need to untick CPI. You want to know the future value, not the inflated value.
Yeah, that's sometimes, just to touch on that, is we can give you projections over the next 30 years and then the levels of cover will go up with inflation and the premiums will go up with inflation and talk in future dollars. So that's why, we try and, if we do show it, we try and tick off CPI increase because it just gives a more true reflection on $1,000 today is going to be, $1,000 in the future or whatever that premium is.
And have a good relationship with your advisor so you can touch base every year if you want. Like, it's all good.
Yeah.
Just don't freak out and cancel your policy, or don't freak out and go, I want to buy a super fund and just, we'll cancel that. this old mate was uninsured for years. Like, what are we doing here?
Yeah, and to go back to Stephanie's point, it's maybe not even the advisor was aware that the premiums would go there. Like, I'm going to read into Stephanie's comments of like, hey, there was this, the advisor knew it was going to increase and I just didn't get sent the projections. If the insurer has provided this discretionary pricing increase, the advisor has no idea. We, as advisors, we have no idea what insurers are going to increase at what rate. We try and get insurers who have sustainable pricing over the long term. But to be honest, a lot of advisors don't even know the initial selection discount that's on the policies.
I'm going to ask you a question that I always ask you.
Yeah.
Do you just put clients to the insurance company where you guys get paid the most, you filthy animal?
The answer is no. Anyone who's gone through our process at Skye, we do a huge deep dive on their health history, and that's first and foremost where we will place the business. So we will recommend an insurer who's going to likely give us the least amount of exclusions or loadings because that has the biggest impact on
That's
the client's
price.
policy.
I'm talking about commission.
Well, so that's our product selection.
Yeah.
So we select based on that. Now, regardless of which insurer we select, we get paid the same percentage.
Because that's legislated law.
Exactly. Yeah.
Awesome.
So we may say, hey, Glen, go with this insurer. They're going to charge you a higher premium.
But they'll cover your medical condition.
Yeah, correct. But we're only getting 2 exclusions instead of 3, and that's why we're doing it. And we have that all pretty openly available in our advice.
Gaurav, if that's how I pronounce your name, apologies if it's not correct. What is the recommended income protection waiting period if I have a 1-year cash buffer?
Yeah, so this is a great question, and I did a bit of research on this one. That's why I wanted to make sure we hit this question.
Giddy up.
Is, waiting periods, different insurers have different waiting periods, but it's 30 days, some have 60 days, 90 days. So 30 and 90 are the most common. Some have 60 days, some have 6 months, some have a year, some have 2 years. So I just did a quote for myself as a financial advisor on $150,000 a year. So 70% replacement of that income, which is a decent amount, and moved a 90-day waiting period to a 2-year waiting period. And the price went from, with this one insurer, who actually wasn't even the cheapest when I did a few quotes, but basically went from just under $1,700 a year to just over $1,300 a year. Yeah. So it's a $390 per year savings in premiums. Happy days. We're saving money, but we've gone from a waiting period of 90 days to 2 years. So when you factor in, if I went on claim and had to wait that long and couldn't earn an income, then that's a significant drop in income. So
yeah. It's just that's awesome. You got a 1-year cash buffer, but still do a 90-day. Because what if in 3 years' time you've had some freaking event and you had to spend the emergency fund, and at the time of claiming in 3 or 4 years' time, that 1-year buffer isn't there anymore.
That's right.
You're royally screwed.
And so, this assessment, basically at claim time, I've lost $183,000 worth of income, pre-tax income, to save $390 per year in premiums.
Yeah.
So you're never saving that buffer when it comes to insurance.
And I think it's okay, when I talked about at the start of the episode, let's work out the need, let's get a cost, then let's chat. A lot of people want to chat first. It's like, no, let's work out the need, let's work out some recommendations, let's look at the cost. I think I told you, a friend of mine, I referred them to Skye, and I think Trent was their advisor, did awesome job, and he texts me, he's like, oh, what should I do? I'm like, you shouldn't be asking me, but thanks for asking.
Yeah, this is what you should do, yeah.
Skye's rubbish, do what I say, not what they say. But I think what I'm getting at is, based on their current situation, the recommendation was a 60-day waiting period, 2 months on income protection. And I'm like, that's fine. I think he had the price for the 90. I'm like, I think when we get to that let's chat thing, you're allowed to actually be a bit flexible and go, okay, well, Skye saying 60 days, I can probably beg, borrow and steal for a month if something happened. And I just said to Nath, I'm like, just do 90 days.
Yeah.
Like, it's all good. They've got a responsibility under law to issue advice that's tailored and appropriate and in your best interest.
Yeah, you definitely didn't give him advice.
No,
either.
not at all.
Yeah,
No.
just in case Ashik's listening, you
Yeah.
didn't tell him what to do.
No.
But I mean, our forms, at Skye, our forms ask how long can you reasonably survive without an income?
Yeah.
And then we base the waiting period off that. And so that's what our official recommendation would have said, 60 days.
And for the record, I said, look, just look practically. Do you
I
think you
know.
could survive 3 months? Then make a decision.
And that's probably why they had that quote option. In the meeting, Trent would have gone, "Hey, this is what you told us.
Yeah.
This is why we've gone a 60-day waiting
This
period.
is what you've said. This is what the textbook recommendation is.
Yeah.
However,
here's another option.
Yeah.
Alternative is 90-day waiting period. Here's the savings. Is that important to you? Or a 30-day waiting period. Maybe you want to just pay a
be a bit more conservative.
and cover that gap.
Yeah. So, and that's what I mean. Like, it's totally okay if insert advisor here recommends 1.1 death TBD. Let's just call it $1 million each. Like, just be informed, but don't start doing the let's chat before you've got the data on the table.
Yeah,
That's all
exactly.
I'm saying.
And our big belief at Skye is we want to educate our clients to make informed decisions.
100%.
And that's the most important thing. If we can say that we've educated you and you've made an informed decision to increase your cover, actually, this friend, they increased some of their cover as well. Or if you've made an informed decision to dial back the cover, then happy days. As long as you've made an informed decision and, similar to this question, do you want to save $400 a year, but at claim time, if you
And that
can't
$400
work,
tax deductible, mind you.
yeah, exactly. If you can't work, you're losing out on $183,000.
Yeah.
So you just need to claim once for it to pay for itself.
Finishing is basically a couple of questions here. Nathan asked, at what point should I dial back or cancel the income protection, trauma and death cover? Hey, there's another episode on Retire Right where we're basically in the title, it will say, when should I cancel my insurance? I'll just send you over to that episode on Retire Right because we're going to record that with Phil. But Caitlin and Carla, basically a statement of when should we review our insurances. So in finishing, when should someone review their cover? Is there life events?
Yeah, big things are life events.
Right.
So if you're starting a new job, if you've increased your income significantly, you've got debt or you've paid off debt, significant debt, starting a family, going through divorce, like all of those major life events is when you should go and revisit your cover at the very least. Outside of that, if premiums are becoming unsustainable, they're different trigger events that goes, actually, let's pick up the phone, have a chat to the advisor who set up these policies to go and review, do I actually need this level of cover or not? Because you may think your life hasn't changed that much. My income's kind of, gradually gone up, maybe 1 or 2 promotions since. Well, when you factor it into the level of cover that you need, maybe there is a big uptick in levels of cover you need, or decrease in levels of cover.
So if people want to either review their insurance or look at taking out insurance, you might be starting a family, you might have just got a mortgage. And this is it. If you're single and you've just got a mortgage, well, it would be nice to get some TBD cover. So if you couldn't work ever again, the mortgage is cleared. And I will say, as much as I'm here to promote Skye Wealth and, Phil's been a great supporter of the podcast and many listeners, Phil will send you back to your own advisor if you tell them that you've already got an advisor. So like, number one, go back to your advisor because we really believe here that we respect professionals and their relationships. We're not here to steal business from anyone else, but what would you like?
Yeah.
Reach out.
Yeah, you reach out to any of our team. You can just go onto our website, skye.com.au, click Get Started, and then book in a phone call with any of our advisors.
But if 12 months ago or 2 years ago you went to an advisor and they were good and set your policies up, don't go to Phil or Skye. Go back to your own advisor.
Yeah, one thing, here, I'll get on my high horse here.
Giddy up.
Like, if they haven't reached out to you and been amazing supporters and been super proactive, at the end of the day, it's your policy. go and call them up, because they, and that's why we tell people to go speak to your original advisor, because they'll know your situation. They'll know intimately why they set up the policies that they did. They may understand your health history as to why, maybe we've structured the policy this way, that we just won't have access or understanding of that. So that's why we're big believers in going to your original advisor, because, we charge a fee to help set up or amend policies with anyone who's not our client. But the original advisor who set up the policy may not charge you that fee.
And if you're a friend of mine or you know me and you want insurance, go to Skye Wealth, but don't tell them Glen sent you. Just say you heard about them on the podcast, because I don't want the text messages.
Good or bad?
Good or bad.
Yeah.
That's right. So, no, it's all good. Phil, Skye Wealth, thank you so much for supporting our listeners, and thanks for coming on the show. We're going to do another episode now for Retire Right, mainly around that. If you are over 55 or the kids are leaving home and you want to know when to cancel your insurance, it's over there on Retire Right.
See you there, Nathan.
See you, mate. Bye.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds financial services license 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective license holders.